end session. I'll pop back to it.
It's a little bit delayed.
Okay.
So you know.
All right. So yeah, we'll give it a second then. Okay, it did show up.
Perfect. All right. Yeah, you're good. So
Okay.
go back.
I want to welcome everybody today. We have our pension committee. I'd like to turn it over to Joe.
Thank you. I don't have any stand-up like Nick did.
That's
right. You guys just rest and do it yourself. I'll call the pension committee to order.
Robert.
At this time, I'll turn the meeting over to Tim and Jim from Alesco Advisors, and they'll take us through how bad the market did yesterday, but it's so much better today, right?
Exactly, that's right. Thank you, Joe. Appreciate it. Good afternoon, everybody. It's nice to see all of you in the afternoon for the meeting, and we listened to Mr. Lano's command performance here. That was quite a story. So it's great to be with all of you. I know you got a busy agenda. Greg is going to talk about the actuarial side of the pension. So I'll go through the report really quickly, and I want Jim to provide some overarching comments. But just as a quick summary, we've had a very strong year for the stock market. Performance has been very good. A narrow market. S&P 500's up about 16% this year, led by a lot of the tech growth stocks. But that seems to be changing in the month of July. Jim will have a few comments about that. But in general, we are very comfortable with the allocation of the pension plan as we seem to be moving into a different type of environment in terms of the breadth of the stock market and the performance of asset classes outside of large cap. But with that, I'll jump into the first report looking at the non-salaried plan. On page 1, for those of you here in the room, the asset allocation at the end of June, just shy of 65%. That's in the middle range of the IPS, which you see there listed below. 65% in equity, the remainder 35%, as has been consistently throughout our relationship with Centro, in fixed income between Treasury protected securities, inflation protected securities, and the broad bond market, and about 2% cash at the end of the quarter. So everything within the investment policy range targets. How is that equity allocated 65%? We did not make any changes during the quarter. The largest holding is the S&P 500, just under 50% of the equity portfolio, about 30% in international. That's been consistent throughout our relationship with you. The remainder of the allocation pressed down the capitalization spectrum into mid-cap, small cap, and micro cap. We did not make any changes with that. Except, as we mentioned to you previously back in the end of 2023, added some exposure to companies with higher operating profits. So we've been very pleased with those changes in the value space where we made those changes. On fixed income, page 3, again, we didn't make any changes to the allocation during the quarter. The yield on the fixed income holdings just shy of 5%, about 4.95, with a duration of about 6 years, 6.1, right in line with the Barclays aggregate index, or the Bloomberg aggregate index. We've shortened we've neutralized our duration last year about this time on the fixed income portfolio, and you'll see that impact when we talk about performance. And we've been very pleased on page 4 with our allocation to TIPS, split 60-40, roughly 65-35 between long-term and short-term TIPS. This year, TIPS have actually outperformed the broad bond market. As inflation expectations, the market had higher expectations for inflation, lower expectations than actually have played out. So inflation expectations have not come down as much as the market expected. So TIPS have actually outperformed the broad bond market, and that's been a great diversifier over the past year for performance.
Just a reminder, TIPS is an acronym for Treasury Inflation Protected Securities. And these are Treasury bonds that act a little bit different than traditional treasuries. What happens with a TIP investment is that the value of the bond increases in lockstep with the consumer price index. And so it's a direct inflation hedge in the pricing of the security. The higher the levels of inflation, the higher the increase. And so in a period of time like that we've been dealing with, where inflation has been higher, these bonds they haven't performed on a total return basis. They haven't performed positively, but they performed far better than the bond market overall has performed.
So very effective diversifier as part of the fixed income portfolio. Page 5, take a look at performance, the quarter to date, so that was as of the end of June. It was a somewhat muted quarter for performance, up 1%, a gain of about $400,000, 38.9 million value for the non-salaried plan at the end of the quarter. But we've had a fairly good July so far, and the portfolio is up about another 1%. So that's been very
You know what's
positive, pushed you over
interesting, Harry? I always look
39%.
at this. The capital gain of 1.8 million for the year to date, okay, and income received. Okay, it's 2.2 million, so I'm rounding here.
Right.
We drew about 1.7.
Yep.
Okay, and even if you go from since inception, between capital gain and income received, 11 million, spent 14 million. That's not bad numbers. I mean, when you think about an active pension like this is, I mean, that to me is pretty stable, pretty impressive.
You know, it's funny, Nick, thank you for that, and, but there's a couple key things here. This organization deserves credit in terms of having the right asset allocation, agreeing to have enough money allocated to equities, which you're required to do in this day and age, particularly when we started in a much lower interest rate environment.
Right.
You have to have enough of an equity kicker in order to meet the actuarial return expectations.
Yeah.
We're modeling that out for you. We'll go back to when we started. We were right around 7.25% a year was the number. 7.2, I think, was the exact number, and we've averaged 7.4. So it's a combination of things. It's having the right roadmap, right objectives, having the discipline to stay with it, right? Because we had a couple of scary times here. 2022 was lousy. The pandemic, right when we started with you, right before the pandemic hit, right? Market goes to hell in a handbasket, but we stayed the course.
Right.
So that's the critical thing is we've got the right blend of holdings, and we have the discipline to stay the course. Keep the expense ratio down,
Right.
and don't try to outsmart the market. Let the market do its thing. You're going to have numbers like that for the next 5 years too.
Because it is a very active pension. This is an active pension, meaning participation. And participation means money's going out. Okay.
And you've had effective contributions to the plan too,
Right.
based on the finances of Centro. All those levers have meant this has been a very well-managed plan over the last 5 years.
Very good. Good. Thank you.
Yeah. So you can see, we'll go through the numbers. Nick took us to the inception period in terms of where we are.
I love history.
Yeah, but you can see that you've met the return expectation of the plan as established through the asset allocation and the work of the actuaries. So that's been very positive. I'll take you through page 6 just really quickly. This is a little bit of the information about the asset allocation and the narrowness of the market, and just from an interesting standpoint. You can see in the quarter to date 1.4% return in terms of the equities, but the broad market, the S&P 500, up quite a bit, 4%. So that's a big difference in terms of the performance. But if you follow below the S&P 500 return, every other asset class for the most part during the quarter had negative returns. And the equal weighted index, we've highlighted that here for you, added that in just as a education point. The difference between the two, the S&P 500 is market capitalization related. The largest companies' capitalization have the biggest influence on the S&P 500. So that would be Microsoft and Apple and companies like that. But when you think about it from an equal weighted standpoint, that removes the outsized impact of those top companies, and everything in the S&P 500 is then weighted on an equal basis. And so compared to that, you see the S&P 500 at 4, the equal weighted index down. So that shows you the narrowness of the stock market from a broad perspective over the quarter, and then that plays out, you can see, going back to the last year. Alesco builds a portfolio that's not solely in those types of all large cap stocks from a risk control perspective. So a diversified portfolio, lots of different holdings, and I mentioned that briefly at my opening remarks about how the market's changed. We had a very positive inflation report mid-month on July 10th, I believe. And since that time frame, other asset classes have basically started to perform in a completely different way. Large cap stocks are down about 0.5%, 1%. This is through yesterday's close. not today. Small caps are up 7, micro cap stocks up about 10. So this shift has changed, and because of the allocation that we have, we're able to move seamlessly from one type of market to the next. And that'll benefit the pension plan down the road. And you can see that from a performance perspective. And then long-term, your 5-year returns at 10.2%. That's well ahead of an average return of the stock market over long time periods. And we've been able to accomplish that in a short time period of just about 5 years. We talked a little bit about the real return assets, those inflation-protected securities at the bottom of the page. Just as a comparison this year, when you look at the year-to-date numbers with fixed income and real return, you can see that we've had a little bit of a backup in interest rates this year. You see the 60 basis points loss in the fixed income holdings, but the real return assets up 1.3. That's the benefit of that inflation adjustment on the inflation protected security. So overall, a good diversifier there, and that's played out too over the 1 year period. 3.5% for the real return TIPS portfolio, and then 2.6 for the broad bond market as yields have come down from a year ago in June last year. Comment? Okay.
No, just, I want to just make sure people were following that conversation, because it is an important thing for everybody to understand that the big takeaway is we're broadly diversified, which will allow us, as this market goes through what could be a historical rotation, moving from very concentrated companies that are driving the market to much broader, that your portfolio is positioned to still perform well. You perform well in the rearview mirror. What we're here to talk about today is what's going to be like going forward. We think we're in very good shape to participate.
What do you think, like, recently, is it speculation, is it inflation, is it political, where you're getting these moves in the market where things are dropping 700 or 800 points today, we're back up 800 in the Dow. I mean, why does it take, like, I'm just curious to hear, what do you think, why these take these huge moves down and then up?
Yeah, so first of all, say that it's not unusual. If you go back in time, so the nominal points, if you talk about the Dow moving 800 points, certainly that didn't happen decades ago because the Dow was much lower value. But in percentage terms, these types of movements are not unusual. So the S&P 500, as an example, 2 days ago was down, whatever it was, 2.4% or something like that. And it was the worst single day since I think 2020. But that's not that long ago. That's 4 years ago. Right. So these types of things happen from time to time. So part of it is just how the markets move. What causes it? There's usually some specific economic catalyst or geopolitical catalyst that gets people spooked temporarily, and that usually what leads to the downdraft. And then once people realize that the world isn't coming to an end, they go, okay, well, maybe I don't have to, maybe I should buy those stocks back, and they start thinking longer term. The key thing about the stock market, if I went to a 10th grader in one of your local high schools and said, draw me a picture of what the stock market does over time, right? They'd have this graph, right, that has a squiggly line that goes up, right? And so what happens is, okay, what is that 10th grader telling us? That the stock market is volatile, right? Goes up and down. But over the long haul, it makes you money. It's positively sloped.
I agree. You can stay the course, dollar cost averaging. If you stay that course, it's
so what happens if you turn on CNBC tonight? They'll tell you why the market was up. They'll give you it was because of this particular thing. Yeah. There are millions of people buying and selling stocks all day long. There's all kinds of different reasons. So it's not. Sometimes you can find one particular thing, right, that could maybe accelerate things, but there on any given day there's a whole bunch of reasons, and we also are animals, right? And so the animal spirits, both fear and greed, have a big influence on what we think about things, right? When the markets have been selling off for a while, we're all like, oh God, this is not. And we're the same way. Oh boy, what's happening now? Is it going to continue to get worse? And that's where you really have to rely on the discipline, of the maintaining That's why we have a policy. The number one reason we have a policy is for all of us to stick within the guidelines, the guardrails that the policy requires us to stick within. But we are affected. We're survivors here today because our great ancestors from way back when there was a rustle in the bushes in the Serengeti, they didn't wait around to see what came out of the bush, right? They saw the fear on somebody else's face, head to the highlands, right? You ran out of the fear. That's why we're here. Those people who waited around to see what came out of the bushes, they don't have descendants. Right? So so when we see fear in others, in any part of our lives, we react to that same way. But the inverse of that, the greed side, is also true, right? Nothing is more painful than having your neighbor make more money in the market than you, right? Oh my God, I can't let that happen. So the fear and greed thing goes back and forth, and that's what drives those upward and downward movements. And the same concept happens not just on the extreme days, but on the more moderate performing days where there's, for whatever reason, there's more of a balance between the buyers and the sellers.
Good, thank you. In addition to that, you've got the television. And on down days, they put, the media is very nice. They put guys that are bearish, guys that are short, and they have $1,000 suits, and they tell you if you own common stock, you're the legit idiot.
Right.
And then when you get in your car and you drive home, you listen to Buy Gold Now.
Yeah, so true. Yeah, just keep in mind that the financial media is a business. Oh, yeah. It's a business. They want you to tune in, and the way they get you to tune in is to get you either very nervous or very excited.
Wall Street's the greatest marketing machine ever devised. All right. So that's the non-salaried plan, and we'll move through the salary. Oh, sure.
I'm sorry, on page 4, what do you guys consider long-term tips? Do you have short-term and long-term?
So long-term is the actual, I think it's the 7+ years. It's the Schwab Tips Fund, SCHP. So it's, longer term, and then below like 3 or 4 years, I think, for the short term. So when you put it all together, I didn't mention this, I think, when I went through, but we have about a 5-year duration because of the combination with the short-term tips, and a yield just over 4.6 for the tips portfolio.
For just the tips.
Just tips. All right. So with that, let's jump into tab B. For those in the room, page 9, you're up here. I'll go through this very quickly because all 3 of the plans are managed in exactly the same way. So 65% equity, the inflation protected securities at 7%, and fixed income at 25%, all within the range of the IPS, and just about 2% cash. Equities on page 10, managed in the same way, about 50% large cap, the remainder assets pushed down the capitalization spectrum into small and micro cap, and about 29% in international, allocated in a similar way to large cap and emerging markets. Fixed income on page 11, 90% the broad bond market, and then the intermediate treasury holdings at 10%. No changes to that portfolio. And the same as the non-salaried plan, the TIPS portfolio on page 12 splits 65-35 between long-term and short-term TIPS. Performance, fairly close to the non-salaried plan of just over 1% in the quarter. Value at the end of the quarter of $38.2 million and $407,000 in gains in the quarter to date. And we're up another 1% or so as of yesterday in this portfolio as well, about 38.5 or 6 million. Year-to-date returns about 6%, 2.1 million, 4.2 over the past year, just over 12%. And your long-term return, again, ahead of the plan, expected return of 7% at 7.43 and 11%, $11 million gain. Page 14, you'll see the same performance perspective here on this page as well, about just under 1.5% return for equities during the quarter, and a year-to-date of about 9.5%, almost 18% over the past year. So very strong equity returns over the past year as the market really took off last fall with the expectations of inflation coming down and potential Fed rate cuts. and then long-term equities at about 10% over the last, going back to 2020. You can see the same trajectory for fixed income and real return assets as well, in terms of the diversification benefit of the TIPS versus broad fixed income. We'll jump to tab C on page 17. Take a look at the Utica plan quickly. 66% equity here, so very similar. 7% in real return assets and fixed income at 25, that 2% cash as well at the end of the quarter, all within the IPS ranges. You can see equities, same way, 70-30 between domestic and international, about 50% on large cap. So all similar, allocated in the same way as the other two plans. Bonds on page 19, 90-10 between the intermediate and then the Treasury bond fund. TIPS on page 20, the same, 65, 63, 36. Holdings for the Centro plan, a little bit smaller plan, still at the end of the quarter, a return of about 1% overall for the quarter, 11.8 million value at the end of the period, 127, almost $128,000 gain. And you can see the performance in that long-term return at just over 7%. Same for performance on page 22, all very consistent. It's the benefit of managing these all with the same allocation. So with that, I think we have a couple more minutes. Jim will provide.
Nick, do
we have enough time?
Yeah, go right
Okay,
ahead.
good.
Yeah,
So-
go ahead.
We'll provide
Yeah,
more
there's
comments.
a few slides in here that I think you'll find interesting. Tim's referenced it already, but on page 26, just to give you an idea of how concentrated the S&P 500 is, let's talk about the S&P 500. First of all, it represents about 75-77% of all of the money that's invested in U.S. equities is in the S&P 500. So this incorporates a lot of the money that's invested in the U.S. stock market. Of that 77% that's invested in, of all the stock money that's invested in the stock market, 10 of the 500 companies represent 36% of the S&P 500. So only 2% of the S&P 500 represents 36% of the value. So that's what we're talking about, concentration. And there's risk associated with that, right? We're all told, don't put all your eggs in one basket, right? That's pretty sound, sound recommendation. Well, so that's one of the things that we're working towards is how do we protect the value of these assets for your plan participants, current and future, against something untoward happening, unfavorable happening in a concentrated part of the market. Because they're not just 10 companies that are in all kinds of different diverse sectors of the economy, very concentrated in the technology sector. And even more concentrated in technology companies that are expected to either be at the forefront of the creation of AI technologies or major beneficiaries of AI technology. So what do? Well, we make sure that we don't allow that part of the portfolio to become any bigger than it is, and we keep moving money into other parts of the portfolio, mid cap, small cap, international. International equities right now are very cheap relative to U.S. equities. You may be surprised to learn that on a local currency basis, in other words, not adjusting for the currency impact, on a local currency basis, non-U.S. stocks have actually performed very nicely this year. Not as well as the S&P 500, but in line with or even a little bit better than the equally weighted benchmarks. If you see in the lower chart here, this is adjusted for currency, and on a local currency basis, it's much, much higher, another 30 or 40% higher. So valuations matter. You think about buying any asset you're thinking about, anything from a loaf of bread to a house, right? If you have a certain level of quality and the quality is where you want it to be, the less you pay for that, the better off you're going to be. So this is what's going on in the stock market right now, is that there's some stuff that's really expensive. And there's some stuff they're not quite giving it away, but it's a much, much less expensive. It's a much better pricing. We want to make sure that we have a full complement of the parts of the market that are trading at that more attractive pricing. And that's what we've done. That's how you're positioned. And that should allow you to sleep at night. that we're gonna be able, that these portfolios are gonna hold up well in a difficult market. One of the things that we didn't do a very good job of, and for reasons that make sense, but in 2022, your portfolio held up really well on a relative basis. So it's hard to pound your chest over relative performance, right? The market's down, you're down, but we weren't down as much as others were down, and the markets overall were down. But that spends every bit as much as well over the long haul is outperforming in an up market. So, and it's also a lot easier to deal with, that you're having attractive average long-term rates of return without as much volatility. And we're trying to position the portfolio to continue to perform in that fashion. You know, on page 28, got some shocking news for you. The U.S. economy is doing great. And what's interesting about this, we were talking about, Bob mentioned earlier about the financial media. Well, this has a spillover into the econometricians' thinking as well. And the forecasts are often, if you look back, are often on the negative side or on a subdued side relative to how the economy actually ends up performing. And we show this over the last few quarters. The forecasts were way below how the economy actually ended up performing. And the quarter that was just announced yesterday came in well above 2.8% GDP growth for the last quarter, came in well above the consensus, which was 2%. This is normal. This is kind of a common thing, and what Warren Buffett likes to say: never bet against the U.S. economy. I think it's important to do that. Now we do have international exposure, which is not a bet against the U.S. economy. It's recognizing that the characteristics that drive stock market performance, favorable performance in the United States, also hold true outside of the United States. So just a little bit about inflation. Let's talk about that. Let's jump ahead to the pages 20 or 30 to 31 talk about the consumer. The consumer is doing very well. They've spent a lot of their savings, but they still are making money. Wages are going up. Talk about inflation on page 32. Today, this morning at 8:30, the personal consumption expenditure index was released. This is the favored inflation statistic that the Federal Reserve looks at. They look at the CPI, but they spend more time looking at the PCE number. And that came in at 2.5% year over year. What does that mean? Well, the Fed's target, as you probably know, is 2%. So we're well on our way. And so what does that mean? That means that we're very likely to start seeing the Fed start to cut short-term interest rates. It's expected at this point that they're going to start cutting them in September, which is a month and a half away. So that when the market is based on two things. The stock market over the long haul, Nick, back to your question, with comments earlier, the stock market cares about earnings and interest rates. That's it. It sounds very callous, and it is callous, but that's what the market's about. The market is a discounting mechanism of cash flows.
When I sit around this table, my friend over here, Melissa, we like the rates where they are right now because our treasury's on the operating account. It brings us some damn good money back. You know?
Yeah, good. All right, so
Right, Melissa?
I don't know enough about that specifics, but the thing to be worried about now is reinvestment rate risk, right? The interest rates drop.
Right.
And all your money reprices as rates drop. So you want to go out on the yield curve a little bit to lock in today's interest rates, and that would be something that we could talk about that if you want.
Yeah, totally.
But so the inflation numbers, back to this whole 2.5% number, inflation's going in the right direction, and it's going in the right direction at the right rate to such a degree that the Federal Reserve is worried about their other mandate. So they have two mandates. We all hear about fighting inflation, right? But the other one is maximizing employment. And they're worrying that jobs losses may start to take place because the economy slows down too much. We're seeing a significant decline in job openings, which is business owners saying we're not going to post jobs for openings like they had just a year and a half ago. There were 2 job openings for every 1 person unemployed. Now there's 1.3 job openings for every one person unemployed. So that gap has narrowed a lot. So now the Fed is saying, well, we don't want to overshoot this thing. Inflation is declining. We're happy with that. We'll continue to monitor this, but it might be a time to start cutting short-term interest rates to help. So who's going to benefit from that? Financial services, number one. Bankers. Are there any bankers in the room? Okay, then I can tell this joke. Okay. Banking is known as the 3-6-3 business. You borrow money at 3%, you lend it at 6, and you're on the golf course at 3 o'clock. So what happens is, so what that of course connotes is that it's a positively sloped yield curve, right? Short-term interest rates are lower than longer-term interest rates. Well, now it's been just the opposite. It's been inverted, where short-term interest rates are higher than long-term interest rates. So as we go back to a more normalized yield curve, and when it's positively sloped, that's going to be really good for banks, and financial services companies. It's going to be good for smaller and medium-sized companies that generally have more variable rate debt than fixed debt. So those are the areas that you can expect to see some favorable returns. And we're starting to see that, as Tim had mentioned earlier, this rotation in the market, this broadening out of the market. The numbers that he mentioned, if you picked them up, are quite spectacular for small and microcap stocks that perform so magnificently in just a matter of a few weeks. All right, and then maybe just the last point to make, just because it's on everybody's mind, is on page 35. Who gets elected and what impact does that have on the stock market? Well, the first answer is nobody told us. Right? We don't know who's going to get elected, right? And but the data is not overly indicative one way or another. Historically, going back to the 1960s, I think we go back on this chart, that the Democrat in the White House has had a better performance in the stock market than when there was a Republican in the White House. But if you're a Republican, you could argue, well, it's because in the Bush administration we had the Great Recession and Nixon had to deal with the oil embargo. And so the real takeaway, if you look at the, I think, more refined analysis of political power and the impact on the capital markets, is that when there's a split in power is when the stock market performs best. When neither party controls both the House, the Senate, and the White House, that does better. You say, well, why would that be? And the reason is because there's fewer changes in the law, in regulations. And that makes that you're running a business and they're not constantly changing the rules of the road all the time. It allows you you have a much better idea of how to go about making money. And so it's ultimately what happens. So I'm not telling you who to vote for or what to wish for or anything like that. I'm just telling you that's history lesson for today, and I'm done talking. Thank you.
You know what's interesting on that chart? Out of the 4 top years, it was split 2 Republicans and 2 Dems.
Okay, there you go.
Yeah.
I mean that okay. Okay, we're good here. Okay.
Any questions? I didn't know.
Keep making money.
Okay.
Keep in the market for
One question. You speak about how it's going to be good for large businesses and small businesses. How it's going to be for individuals?
For
Individual people,
The rate cuts?
Rate cuts.
Rate cuts for individuals.
Yeah, so for, it's kind of just what we were talking about earlier. It's a mixed bag, right? So how much debt does that individual have? The more debt they have, the uglier their balance sheet, the better off, the bigger beneficiary they will be with lower interest rates. If you have somebody who's got a clean balance sheet and they're trying to make money by, buying CDs, their income's gonna drop. So who are we talking about? But, generally speaking, the lower the cost of capital, the better it is for the economy, and the better the broader economy performs, generally the better it is for everybody.
I think the biggest thing with the rates that'll be interesting is you just stated the lower cost of money. So what's gonna happen to the housing market? Okay, once those rates, mean, if you go back to the eighties, you said 6%, oh, that's a pretty damn good rate, right?
That was
Then
a
we got,
scale.
we got spoiled, right?
Pretty good rate right now.
We got spoiled at 3 and under 3 and everything, and then, right, Robert?
I sold people 14% tax-free state and federal.
Wow.
New York State Municipal Assistance Corps, 14 and 8. Back then, the maturity was 7108, and they came out at par. A-rated.
So that'll be impactful, if those rates,
Yeah, that should free up a little inventory, then get some more supply. We could see a little softening in the housing market, more turnover. That'll be a mixed bag too, because housing valuations have a huge impact on household net worth, aggregate household net
Sure.
worth. So we don't want it to, we'd like to have supply increase without a big drop in pricing.
That's like late fall. early winter. Okay, I see that, but I see it November and December,
Probably more than 25.
February, yeah, February.
The other industry that's affected severely by the very low interest rates is the life insurance companies, because that's based off of interest rates.
right?
And when it was 2%, and they factored in that they gotta get, they're paying out 4, and they gotta get an extra point to pay the light bill,
Yeah.
2% kills them.
I'm so glad you guys are following this daily reports.
Wall Street Journal. Okay.
We're gonna get
Thank you.
Thank
See
you,
everybody.
thank you guys, I
Yeah.
appreciate it, thanks for your time. So we're gonna get into a little
Golf
bit.
course play too.
Time for lunch,
Close.
Not today. What did you say?
This will keep you awake on Friday, we're gonna talk about actuary.
Oh, do you want us here?
No, if you guys wanna see it, it's up to you, if you want to, if you gotta go, that's fine too, whatever you guys wanna do.
Oh, happy to stay.
Yeah, go right ahead, go ahead. Okay, go for it.
All right, I will tell you up front, or I guess I should say warn you, this is probably the longest presentation I'm ever gonna have for you.
Okay, so we're not gonna stay.
I'll explain why. I mean, I printed it two per page to make it look smaller, but on the screen it's one slide per page. But so we're gonna talk about a little funny background, because I like to. I'm looking at the bottom half of the first page printed, because I like to start with that to put things in perspective. You see this once a year. I deal with this stuff every day, so it helps to kind of explain that again.
Yeah.
We have evaluation review for the 2 plans, assumption review, which is the main part of this, and future outlook. I will say for the assumption review, it's never been done. I know that because when we started a few years ago, we looked at the prior reports and said, this is like old school assumptions. This is what we were using back in the 70s and 80s. I wasn't, but our industry. So I realized this plan's never had an assumption review. So it's time, and it's something that we do once every 5 years, which is why this is going to be the longest one. So we'll have a break the next 4 years, and then we'll come back with another long presentation. So funny background, can't really do slide 4, yeah, right there. So this is kind of how it works. For every person in the plan, we calculate a liability and normal cost, we'll put it all together, and that's the total for the plan. So it's always done on an individual basis. For someone who is just hired, which you're dealing with closed plans, so we don't have that here, but you don't need any assets for them because they haven't accrued any benefit yet. But there is a cost. So, and it depends on their salary, it depends on their age, etc. So, for example, that might be $4,000 a year. To the right of that, for someone who just retired, there is no more cost. They fully accrued their benefit, but we're going to need a pot of money as part of the 38 or 39 million that's going to fund their benefit for the rest of their life. So in this example, it's $200,000. For everyone in between, there's both. There's an asset target, so we can say, all right, well, this person's been working here for 15 years. We should have $75,000 for them, and we're going to put in $6,000 a year. They're further up in their career. So that's the way the whole thing works. And so everybody's done individually, it's all put together. The most expensive person in the plan is the person who just retired. And the terms we use at the bottom of the page there are actuarial accrued liability. So when you read the valuation report, it won't say assets needed, it'll say actual accrued liability, and the annual cost, we'll call that normal cost. So that's the background, and so I might refer to that a couple times along the way here. And the rest of it is, here are some of the things that affect the cost of the plan. So I have this helps hurts chart I've been using for years, and at the bottom it explains what it means. Helps means your funding goes up, contributions go down, and hurts means the opposite. Investment performance is pretty obvious. If you get more than you expected, it helps. Less it hurts. Won't go through all of them, but retiree longevity, meaning how long retirees live. If it's more than expected, they're living longer than expected, that's great, but it hurts the funding of the plan. We're going to come back to that point later. Retirements, if you have more retirements than expected, it generally means people are retiring earlier than we thought. And when people retire earlier, think of that number line, it gets cut off a couple of years before you thought, so you don't have as much time to build up funds for it. So that tends to hurt. Terminations, meaning people leaving, quitting, getting fired, whatever, turnover. If you have more of that than you expect, it's a bad thing. But in terms of the pension fund, it actually helps. You know, if everybody quits, you don't have to fund their benefit anymore. So those are the things we look at every year. We look at 1 year to the next and say, okay, what happened from 23 to 24? And then every 5 years, we look at, all right, what happened over the past 5 years? And should we adjust our expectations? That's the assumption review part of this. Before we get to that, I'll talk about the valuation summary. Now, this is preliminary. That you haven't seen the report yet because we're not done with it. But I just took I took where we are now and took the preliminary results and said, all right, I'm going to share that report. So year over year, I won't spend a whole lot of time on this page, but we see a pretty stable active population in terms of number, average age, every years of service. Same thing with the inactive population. Average age of retirees is up a little less than average benefit, up as expected. We kind of see that increase every year, and the total paid in the prior year is also up. The next page shows the actuarial figures. So remember, actuarial liability, that's the assets needed. In a perfect world, we'd always be exactly 100% funded. We'd have the amount of assets that matches that. But we're pretty close. So in 2023, we were 90% of the way there. 2024, about the same. Now, this is all as of a snapshot. So all the stuff that Valesco just went over, they were talking about as of June 30. We never look at it as of June 30 for the assets, or even for the liabilities. It's always as of 4/1 every year. It's just one snapshot a year. Cost of the plan, pretty similar year over year. You have two components. You have that normal cost, which again is anybody who's actively accruing benefits, not yet retired, they have a normal cost. Put them all together and you get those numbers. The amortization is, well, if you're not exactly 100% funded, you're going to have a payment to get you closer to 100%. If you happen to be 120% funded, that can be a negative number. Normal cost can never be negative, but the amortization can. And I don't know if I'm going to end up going past 2 o'clock, but if you need to give me the hook.
No, go ahead. This is
Okay,
important.
yeah. If you need to give me the hook at any point in time, that's fine. A topic we talked about last year is on the next page, which is asset smoothing. So this plan had never used asset smoothing before, which is unusual. Well over 90% of the plans I work with use some form of asset smoothing. So
Define asset smoothing for the people that don't have your background.
yeah, that's what I was just getting
Oh,
at.
okay.
So what does it mean? Well, first of all, you can't really smooth assets. I mean, the assets are what they are. You can only pay benefits with the real assets of the fund. Asset smoothing is what it's been called for decades and decades, but it's really contribution smoothing. So how it works is when you have a really bad year, like last year, you can see there's a 0 line in the middle, and the blue line is how much of a loss there was. That loss doesn't mean negative return. It means anything below what you assume. We're assuming 7, anything less than 7 is considered a loss for us. You recognize 1/5 of that immediately, and then 1/5 the next year, another 5th, another 5th, and so you start building these layers. You have losses, you have gains, which is exactly what you see there, and you recognize 1/5, and so the layers kind of cancel each other out, thereby smoothing the contribution. So that's why it's called asset smoothing. The reason there's nothing in 2020, 21, and 22 is because we didn't start. There was no asset smoothing before that, so we just said, let's start now, 23, recognize 1/5, go forward. So when I show you projections of the cost of the plan and the funding of the plan, that's gonna play into the first 5 years. Similar few slides here for the non-salary plan. And what you see there is kind of a similar pattern. You know, it's a stable active population, stable retiree population, average benefit up a little bit. And on the next page is the actuarial results. Funding ratio pretty much the same year over year, 87% and then 87% again. Now it says smooth value in parentheses there. So that means when you think about that asset smoothing I just talked about, that takes into account you haven't recognized all of the loss from last year, and you haven't recognized all of the gain it just had. And so there's an 87% funding ratio. And I don't need to explain that. It looks very similar. It's almost the same exact numbers, but same concept there. So the main part of this is the assumption review, and on the next, there we go. So the way this works is we have to set assumptions to determine annual cost. We have to guess how long people are gonna work here, for the salary plan, what their salary is gonna be, how long they're gonna live afterwards. And so that's just part of the evaluation. You can't do evaluation without assuming those things. And then every year we come along and say, all right, what actually happened? And we make adjustments. Did we really earn 7%? Nope. We earned 1%, or we earned 12%. And so that's one adjustment. Did we really have the number of people retire we expected, or was it more or less than that? So that's an every year thing, self-correcting. And then every 5 years, which is where we are now, we look at all the assumptions and say, do we need to make any adjustments? And having never been a study done before, I knew before we even started this, yes, we were gonna make some changes. So the next page is just a snapshot of the assumptions for each plan. Pretty similar. And I will point out, I'm not gonna read the whole thing, but I will point out a couple things. The retirement is just when people are eligible for the most part. And in reality, it doesn't happen like that. You have people retiring at different ages. Some people stick around much longer than the first eligibility. The mortality, the IRS tables are actually required for private sector pension plans, but they're not required for a public sector plan and not necessarily even appropriate for a public sector plan. So that's what I meant when I said these were kind of old school assumptions. These are assumptions that were developed, not even developed, just kind of assigned to this plan by the prior actuary. And you know, they've been working okay, but it's time to kind of fine tune things. So there's two categories of assumptions. The next page is the economic assumptions. So inflation is the baseline for everything. You know, there's what they call the building block approach. Inflation plus some real wage growth equals your salary increase assumption for the salary plan. Inflation plus a real return gives you your investment return assumption. So it's all based on that. We're assuming 2.75% inflation, and we think that's pretty good for now. I mean, it was dropping for years. It was 4% 20-some years ago. That was what every actuary was assuming. And it was 3.5, and 3. It stayed there for a while, and then recently got to 2.5. But the past few years, we realized 2.75 is a pretty good number. Long term, all the assumptions are long term. The investment return, which you can go to the next page. That 49% comes from this graph. So this requires a little bit of an explanation. The way we have to evaluate every assumption. You can't just say, well, you know, what are the other plans doing? Or, you know, what do we want this assumption to be to fit our budget? You have to have a basis for every single assumption evaluation. So what we do here is we collect information from Alesco and all the other investment consultants we work with. They tell us for each asset class what the long-term expected return is, what the long-term expected standard deviation is, and what the correlations are between the asset classes. Then we have our own simulation model that produces this graph. And what this does is I'll stand up here for a minute. It's the blue line that's the simulation. And it just shows you the probability of this return over 30 years. 30 years is considered a long time for actuaries. So the probability of getting at least 0% compound over 30 years is 99.9% you're gonna get. Probability of getting 14% compound, not gonna get it, 0.1%, right? But it's very steeply sloped in the middle, and it looks like that's, anytime you invest in risky assets, you're gonna have that steep slope. So what we do is we say, all right, the median was 6.95%. That's just based on the simulation. Your assumption is 7%. We're not going to recommend change. It's 5 basis points. So that's what the simulation tells us. There's some interesting probabilities here. You can see it's even between a 60% probability and 40%. That's almost or more than a full percentage point. So that's what makes it the trickiest assumption. But that's the way we evaluate that assumption. If we had modeled this and you were assuming 7 and we got 6.4, we would say, let's talk about decreasing it. Not the 6.4, but just decreasing it to whatever level we're comfortable with. But that wasn't the case here. If we did this study 6 years ago, we would not have gotten a median of 6.95%, because you look at the fixed income market, as the point was made earlier, it was so low, it was hard to justify 7. Right now, it's not that hard. Career salary increases. So this is the way we look at this. We take a snapshot of the population and say, all right, what's the average salary for each service level? Right, now being a closed plan, we don't have anybody under 10 years or even 11 years of service. And so those blue dots are the averages for everybody with that much service, whether it's one person or 5 people or whatever. And so we try to fit a line through there and say, all right, what does that tell us about the change in salary from one service level to the next? And 3.5% actually fit pretty well. So it's inflation plus a margin. A lot of times we'll find that there are steep salary increases at the beginning of people's career and then it kind of levels out later. We don't have any beginning of career numbers here, so no change recommended there. Last part of the assumptions is the demographics. So the way we do this is we determine an expected value of deaths, retirements, terminations, etc. over a 5-year period, and then we see what actually happens. Compare the two. We have this thing called actual to expected ratio. If your assumptions are perfect, it's 100%. You have exactly what you thought. And then we look at the pattern based on age, service, gender, which plan it is, and say, is there a need for a change? So it's possible that you have 10 retirements, and you expected 10 retirements, but the pattern is not what you thought. In that case, you would change the assumption. So the first one we're going to talk about is mortality. And I will tell you that, I already mentioned that first part earlier, but the plan populations are not large enough for us to just look at the mortality experience and say, okay, here's the table we should use. So for a large plan, we work with some large plans with several thousand members. So we can actually look at their mortality experience and say, all right, that's pretty close to this table. So here we just base this on similar clients and say, all right, this plan, the best table to use is Pub 2010G. That means public sector. It's been 5 years now since they published public sector tables for the first time. G means general. In other words, not teachers, not police or fire. So everybody else is public sector. So that's the best table to use here. And there's this projection scale that this is a best practice now. It's an actual standards practice. But what the projection scale does is, for the mortality table is a bunch of probabilities. So for example, 80-year-old female, if the probability says 1%, that means they have a 1% chance of dying within the next year. It's probably close to that. What the projection scale does is it says, well, we know the life expectancy has been increasing little by little for decades, disrupted a little bit by COVID, so that jury's still out on that. But over time, it's definitely been increasing. And the projection scale just says that's going to continue to happen. And that's kind of good news because you're not going to have like a huge increase from a new table at some future point. We're just constantly building in those projections, and the 80-year-old that had a 1% chance of dying in the next year, for the next valuation, they're going to have a 0.95% chance of dying, so a little bit lower, which means longer life expectancy. So that's actually the biggest change. It's just going from those static tables, the IRS tables, which do not have the projections, at least generational, to something a little more appropriate. Next assumption is retirements. So it's the current, it was outlined in an earlier page, but the current assumption is that people retire when they're eligible. And using that assumption, we would have expected 17 retirements over 5 years, and we got 17. The average rate was 20%, meaning that for everyone who was eligible to retire, 20% of them actually did.
Say eligible, you mean like they're 62 or they served here 20 years?
Whatever the eligibility of the plan is.
Okay.
I forget off the top of my head, but yeah, it could, either by age or age and service combination. Yeah. So yeah, the current rates assume that all employees retire at normal retirement age, but what we found was that it's at different ages. So the retirements are more correlated with years of service than age. And so on the next slide, we show, and there's a mistake on that. The right-hand graph, it says age, it should really say service. Hand out here. Yeah, that's supposed to say service. So what we do is, and we spend a lot of time on this, we look for correlations and statistics and things like that and say, well, what's a better assumption based on age, based on service, based on first eligibility? And what we found was that it's pretty well correlated with years of service. Under the current assumption, if you take all those service buckets, you get the actual number of retirements. So for example, 25 years of service. There were 8 retirements for 25 to 29 years, but we only expected 3. And so on the right-hand graph, we're correcting that, and we're basing a new table based on years of service. So it increases with service levels so that now we are expecting about as many retirements at those upper service levels as actually happened. By the way, this is not an exact science. We're not trying to match each one of those bars perfectly and just pretend that every 5 years going forward is going to look exactly like the last 5. Real world doesn't work like that. But we try to get closer. So yeah, we're still coming up with the same number of retirements, but the ages or the service levels a little more correlated. And that's all for the salary plan. We'll go over the same thing for the non-salary. But terminations defined as just leaving employment before you're eligible, whether you quit or get fired or whatever. So based on that standard table that's being used, which is a very, very old table, by the way. It was published in the Actuaries Handbook in like the 1960s. So using those rates and tables, we would have expected 1 termination over the 5-year period. What actually happened was 7, more than expected. So you think about the helps and hurts that I talked about earlier, it actually helped. You have more people leaving than you thought. And the average rate was about 6%, meaning that 6% of people who are not eligible to retire left for one reason or another over the course of that 5-year period. The pattern, as we looked at it, was, and it's only 7 people, or 7 terminations, it's not related to age or service. So a lot of times we'll find out that there are higher levels of termination at earlier service. People come on for a year or 2 and like, I don't want to be here, they leave. But this one, there wasn't any correlation. So we are recommending just a flat rate of 4%. And so when we do that, you get what we see on the next page. The left side. So the left side, these are labeled correctly. The left side is actuals in the red, it's all color coded. The actuals in the red, expected in the green is what we thought before, expected in the blue is what under the new assumptions. So yeah, before we were only expecting just very low levels of termination. Now, and again, not an exact science, but we're expecting something a little bit higher. We're not expecting a full 7 terminations every 5 years because it's a little more conservative to not go all the way there. We don't want to underfund. So, last assumption for this group is disabilities. The assumption is 0%. There was 1. That's not enough experience to change. So we're probably just maintaining 0%. If you had 10, you would say, all right, we should probably adopt an assumption. And the last, there's 2 more parts of this. So this is just an overall summary of what did we think before in the blue, in the green, number of retirements, number of terminations, number of disabilities, what actually happened in the red, in the middle, and then what our adjusted expectation is in the blue. So these are not huge changes. Again, mortality is going to be the biggest one and it affects the cost. But on the next page, we show how all those recommended changes impact the cost of the plan, which might be the most important slide for us here. So retiree longevity, it's people who are living longer than expected. It's going to hurt the fund. That's going to drive up the liability level. Retirements coming in earlier ages for some people, that's going to hurt. More terminations than expected, that's going to help. Balance is there's an increase in the liability of about $1 million. And it's a lower funding ratio by about 2%. And one thing, it's on one of the later slides, but we don't just automatically build the assumptions into the current valuation. it'll be next year. So this won't affect 24 valuation, it'll affect 25. Yeah, increase of the ADEC, which stands for actuarially determined employer contribution, 27,000 per year. So you might wonder, if you know what some of these numbers mean, how can it be $1 million increase in liability and only a $27,000 increase in annual cost? The reason is the normal cost actually dropped. So you got those two components, the normal cost and then amortization. So yeah, the amortization is gonna have to pay for another $1 million, but the normal cost is actually lower under the new assumptions, mainly because of the turnover. All right, the outlook for funding is on the next page. Yeah, so this is starting in 2024, going out 15 years. And, you know, what do we think the funding ratio is gonna look like? And what do we think the unfunded liability is gonna look like? Now, this is just in a perfect world, all right? Which means, all right, so this is based on the new assumptions for next year, but it's also based on 7% return every single year. Everybody retires in accordance with the new assumptions. Everybody lives as long as the new tables indicate. It's a good picture. The funding ratio is increasing, the unfunded liability is decreasing, but you have a weird kind of trapezoid thing in the beginning there. Part of that is just an extra $1 million for the new assumptions. And then that level unfunded liability for a couple of years, that's recognizing the losses from last year per asset smoothing. If there were no asset smoothing, it would just go straight down. So, and a lot of times you'll see after we have 5 years worth of asset smoothing, you'll see it kind of bounce around a little bit for the first 4 or 5 years. Projected cost goes along with that. It's the two components. It's the normal cost for every active employee and the amortization as you move closer to 100%. As I mentioned, the normal cost actually drops from the new assumptions. That's the whole explanation for why it goes from 330,000 one year to low 200,000 next year. Because we have different assumptions, lower normal cost, higher liability, which is not unusual. This is also based on 10-year open amortization. As you might know, when we provide the actuarial report, we show what if you amortize it over 10 years, what if you amortize it over 30 years, and then a decision is made here, which is what's going to be contributed. I'm going to go a little more quickly through this. In fact, we'll just look at the graphs for non-salary, unless anybody wants to get back and look at more of the details. But it's the same explanation, same methodology, just a different claim. So for the non-salary plan, there was a higher correlation to age versus when people retire versus service, right? And everybody was expected to retire at age 62. That's why all the green bars started at 62 on the left. So nobody was assumed to retire before that age, but in reality, people actually did. So we're recommending a different assumption where it aligns more closely with that, where we actually have rates, pretty low rates at the lower ages, but rates that reflect what's actually going on. For the termination part of it, which is 2 slides later, it was also more correlated with age. Generally, we see more correlated with service, but in this case, it was more correlated with age. There were more terminations than expected. Quite a few in the 50 to 59 age range. With the new assumptions, we are not trying to match that and say, yeah, we're going to just have this high level of termination going forward, because that's not a good way to fund your plan by expecting everyone to leave. However, clearly, the actual experience has been more people leaving than we thought, or than what was based on that simplified table. So a little bit of a change there. For disabilities, a slightly different story. There was a 0% disability assumption, but we had 3. Which, you know, if it was 1, we'd probably say, no need to adopt an assumption, but 3 is getting to a critical mass. This is not a impactful assumption, but we think it's appropriate to adopt a low rate of disability, 0.75% per year. Same type of graph there, you know, what we thought, what actually happened, revised expectations, and the cost ends up being somewhat similar with the mortality table. It's the same tables for both plans. That's going to hurt a little because people are living longer. Retirements, you have the earlier retirements, it's going to hurt a little bit. Terminations, it's going to help, same story as before. disabilities hurts, but it's to the tune of, $1,000. So we have a similar increase in liability, but a bigger increase in the contribution because we didn't have as much of a drop in the normal cost, just a slight drop. The funding outlook looks very, very similar, and the reasons are the same. Increase for the assumptions, assets moving for a couple of years, and the projected costs also look similar. You see a small decrease in the normal cost, but that's why you have a expected $123,000 increase in the contribution. So, but in the long term, things are looking good for both plans. Both in the 90% range. The last slide is this. We'll continue to improve. The investments have been managed well, the contributions have been managed well. The asset smoothing is working as intended. It's even almost perfectly. One bad year, one good year. It's the whole point. And overall, the funding, keep this in mind, you saw a -2% in the funding ratio. It's gonna look worse, but you're actually strengthening the funding of the plan by making the expectations more in line with what's actually happening. And again, assumptions are gonna be reviewed every 5 years, so I will have a shorter presentation for you next year. And we will have the full reports coming out soon.
Questions? What about from our investors? Any questions?
That
That was a good report.
was outstanding.
Excellent.
It really was. I mean, very thorough, but
Yeah.
understandable, which is hard to do in your world. It's complicated stuff.
And I only went over because you went over.
No, when you gotta make time, when you're talking about $90 million, okay?
Yeah.
We gotta make sure we pay attention.
Oh, and by the way, you're putting all the plans together. I did a very similar presentation for the Utica board last month.
Thank you for saying that number the size of the pension plan. So the projected increase in the contribution from Central, 123,000, that's not a lot.
Right.
Yeah. Can you clarify a couple things? You said 120% of an overfunded pension plan is a bad thing. You said that in the very beginning.
No, I didn't say it was a bad thing. What I said was, you're always working towards 100%. So if you're 90%, you're gonna add a little bit to the contribution to get closer. If you're over 100%, you're gonna offset. You're gonna take that normal cost and subtract a little to get, same reason, to get.
And that's what
closer to
destroys them when they smooth. You're right, that's the negative of municipalities don't make the contribution they should make. That destroys the smoothing when the market's down in the following year. Yeah, no, I get it.
Yeah, and my recommendation for plans that are overfunded, over 100%, is like preserve the surplus. Instead of spreading it out over a 10-year amortization, make it 30.
Yes.
So if we get to a point where we're 110% funded, I'm gonna come in here and say, spread that out over 30 years. You have a better chance of maintaining well funding.
That's why in one of the years when the market really did bad, the following year, school districts upped the taxes tremendously. Okay, one more quick question, and this is the most important number. You said the pension was 87% funded.
Yes.
That means it's fully funded.
87%?
Yes.
Well, okay, there's a bit of semantics there. So, fully, I don't like the word fully funded. I mean, you could say 100% funded. You want to call that fully funded? Fine. I mean, that's probably the closest thing. But it's a moving target.
Yes.
So 100% funded at one day could change the next day. I mean, look at the stock market. If we did this valuation every day, you'd go from 87 to 90 to 83. But so 87% is a strong funding ratio.
Yes, that's what I'm trying to say. When we being on the board, hear the number 87%, we should feel comfortable with the stability of the pension plan.
Yes. In fact, if you ask me, I'm really comfortable when the funding ratio is between 85 and 90. Because when you're exactly at 100%, it becomes really volatile. Your unfunded liability can go from $0 to $1 million in a day. So, 85 to 90 is easier to manage the costs.
Okay. Good job, guys. Everybody, good job.
Thank you.
Thank you. Thanks for coming in. Good to see you.
Yeah, the labor meeting comes.
I really make a motion.
Okay, we're going to go right into, audit and finance committee.
Thank you.
Okay. Melissa.
For Christine.
Oh, John Maylock.
Yeah. I don't know if we're gonna do, John Maylock and,
John and Doug.
yes.
Let's take care of let's do, let's take care of you first, John.
John.
All interest. That way for you.
He was talking this way.
Great, John. How we doing there, young man?
I'm here and I'm doing just
Let's talk about our general liability.
for transportation center,
You got it.
okay? Alrighty. Good afternoon, everybody. This is different.
Yeah, I may have created this problem.
Okay.
Okay.
All right, our transportation center is written separately from our property policy and our excess liability policy. Our policy covers the building, the contents, and our legal liability for the vehicles for which we're charging the fee and our parking in our lot. So last year, the premium was almost $116,000. This year, it's $121,594. Our limits of coverage are up to $9,515,310. And that's basically due to the increased costs of construction of our property. And that's up about almost $1 million. Our rental income is up a little, and our parking receipts are up a little. The coverage for the vehicles in the parking lot is limited to $2,000. We've got a comprehensive deductible of $250 per claim and a collision deductible of $500 per claim. The fire insurance deductible is $2,500. And as in the past, the liability in part is based upon the parking receipts. So we estimated, you guys estimated this year, the end of the year, they'll do an audit and adjust the premium. If it's more, we get a bill. If it's less, we get a check. So that's it. It's pretty good. Not too
This
much
is
of a-
pretty common, this nominal increase. We're seeing this all over the place.
No longer nominal, when you
Yeah.
get your own.
I'm not in Florida. Okay.
Okay, anybody have any questions?
Questions for John?
If not, then have a great
Great,
weekend.
John, have a
everybody.
motion? Okay, Tony, second, Tina, any discussion? All in favor, aye, thanks, John. Okay, we're gonna go right into then,
Workers' comp.
yeah, we'll do workers' comp.
Yep,
Workers'
this
comp.
is
Good. I just-
Doug Cronin from Crown Risk Management.
Yeah, hi, Doug.
Good afternoon. If you could take one and just kind of pass them around. Just finalizing this today, so thank you for having me. As I start to go through this, we did bid this out, so this went to a number of different carriers. We went to the New York State Insurance Fund, we went to Chubb, we went to Travelers, Liberty, Hartford, the whole gamut, to try to put together a competitive bid for you. We did receive a couple of bids back. The state fund is a guaranteed cost quote, which was pretty much not competitive at at roughly 3.3 million. Chubb was also non-competitive at this time based on the letter of credit and cash collateral they needed up front. So the expiring, you guys, this is all based off of payroll. You had 32 million in payroll. We estimated the increase to be roughly $38 million. So as payroll goes up, we know that our costs are going to go up. Thankfully, we were able to get a reduction on the actual rate. The rate was $3.55 per hundred of payroll. We got that down to $3.34. Still is an increase in the premium, but again, that's the function of the payroll going up. So it goes from 1,158,000 to 1,267,000. Our administrative expense with travelers stayed the same at 47,241, which is also a function of payroll, but I got them to reduce the rate on that. Our surcharges and assessments did increase, and that's a pass through to the state, which is based off of your manual premium. So your manual premium increases, therefore your surcharges and assessments will go up. Your modification rating went from, I believe it was 1.86 up to 2.25, which is the main reason for that increase. That increase on the surcharges and assessments in a dollar standpoint goes from 265,000 up to 334,000. So as I said, this is a function of the modification rating, which we do evaluate, and we are in contact with you guys regarding that evaluation of that mod. I do expect that mod to decrease in the upcoming years, just based on the mathematics that are in the formula. So our total fixed costs go from 1,471,000 up to 1,649,000. Our claim handling charges decrease. So that's what it costs to handle all the claims. I estimate those costs at about $70,665. So our grand totals are about 1.5 million to about 1.7 million in the increase. Again, the major component of that increase is the surcharges and assessments and the increase in the payroll. Okay?
It's all formula driven.
All formula driven. Yep. So the other thing that's going to happen is, again, this is done by audit. So if you have less payroll, right, we can go down to a 90% level on that, which is good. It used to be 95, so now we have it down to 90. So that's a good thing. Again, if it goes more than 37 million, then there will be additional premium due. As far as our collateral requirements, last year travelers asked for $1.6 million, almost $1.7 million for cash collateral. I believe that's a little bit egregious. I was able to negotiate them down to $1.5 million this year, which also I think is egregious still, but that's probably where we're going to end up for this year. When we do cash collateral, there is a valuation that is done. So the valuation, you do get the cash back as the claims decrease. Okay. And no loss deposit in the escrow, and we do have a buyout formula in year 5 for these claims as we have in the past. On the second page, you can see in really, really small type, we go back and we take a look at the claims going back over 10 years, and you can see that on the far right-hand side, the 23-24 year, we have $288,000 in claims, which is a lot less than what you've had previously. That is a function of proper claims management, in my opinion. Some people call it luck, some people call it skill. We're gonna go with skill today, all right? Those claims are not gonna end at 288,000. At most, those are probably gonna be roughly around 500,000 when they're all fully developed down the line, okay?
It's a significant decrease. It's a significant decrease.
Yeah, we do a lot of work.
Yeah. I mean,
There's a lot of claims and a lot of work. So we've done a lot of work on the claims. As you can see, your years have bounced up high and low, okay? And that's why I say, is it luck or is it skill? We're gonna find out next year, you know? So we know that claims will happen, and what we're trying to do is mitigate the claims as best we can. We're also trying to get the adjusters to look at prior claims to make sure we can repeat claims that are filed correctly. So I really do think, and the mod is all generated off of these numbers. So as you can see, as your claims go down, your modification rating is going to go down, which is going to help those surcharges and assessments in the future. All right, so let's just hope for another. And just for reference, so Travelers is holding $1.7 million of your money and only paying out $288,000 in claims. That's ridiculous. Okay, good. So we're working on that. Baby steps.
Okay.
Baby steps. I just got him to swallow $250,000. So they asked for 1.8
You
million
better
to
give us
start.
interest on
No comment. No comment.
that one. All right.
So, what I'd recommend is Travelers has got a great claims team. They're familiar with the account. I recommend staying with the Travelers for this year. We've now got more interested parties looking at this in year 2 and year 3. Again, just for reference, Chubb wanted $3 million in claims in cash collateral. Like, that's just not going to happen, you know. So that's just kind of ridiculous. So we're going to keep working with those companies and keep telling them what a good risk it is and how we're managing the claims, and hopefully, you know, in years to come, we'll keep having competitive quotes that can help drive down the cost.
Jackie.
No, I just wanted to thank Doug and his team. They're new to this. They've been doing this for the last year, Crown, and they've worked very well with the Centro team to help mitigate the claims and everything, so.
Years ago, Nick, we sat through a meeting where we had a consultant that worked on the workers' compensation and reduce our liability and our costs. Has that panned out?
Yeah, that's Crown.
That's what
Crown,
we
that-
did.
That's Doug right
Yep.
there.
Yeah.
He's the one that's helping us, you
Good.
know, lower
So
those
we're-
costs and absolutely.
Yeah, you went through a code rule 59 probably a couple of years ago, and your mod got too high. And through that evaluation, uncovered a few things. The new processes have been implemented, and I think the processes internally with the claims man. I have an attorney, a workers' comp attorney on staff, so we're able to, as the claim comes in and as we do the claim intake, we're almost able to evaluate it and almost know exactly what's going to happen with the claim right from the start. So it really helps us.
And I think we respect the workers' comp process. You know, our goal is to get our folks back healthy enough to get them back working. And this is something to help them get to back to the job. But this is good work too. Good work. Any questions for Doug? Okay, so we're gonna have a motion to renew with Travelers. Luella, second. Robert, any discussion? All in favor? Thanks.
Perfect, thanks, Doug.
Thank you, sir. Okay, we're gonna move right to Melissa.
All right, good morning, everybody, or I guess good afternoon.
No.
Find out myself.
I'm thinking that way too.
So this is a quarter end ending June 30, so we will be reviewing the statement of net position and the balance sheet. So starting with the statement of net position, ending June 30, 2024, the quick ratio is at 9.5%, which is pretty much where we were at June of 2023. This means we're being consistent, and for approximately for every $9.50 we have in current assets, we have $1 in current liability. So we are very healthy, have a very healthy net position. Anything over 1 is good. So taking kind of a deeper dive into those different categories, current assets are at $57.8 million. That's a 4.1% increase over prior year. 4.4, I'm sorry. The cash and cash equivalents equal approximately $37.6 million. That's a 2.9% increase. The biggest increase you'll see is in the designated cash, and that's largely due to the increase in the paratransit reserve we made back in January or February of last fiscal year. And then additional increases in cash is due to the investments and interest earned. Receivables are approximately 9.1% and in line with prior year. The most notable changes are receivables in regards to the grant receivables, and that is due to delays in grant agreements and revisions at New York State DOT. Materials and supplies are approximately $4.2 million, reflecting a $453,000 increase compared to June 2023. This variance is pretty normal. It's our inventory and our stock rooms, and that's just cost of parts going up and influx in inventory. And then prepaid expenses and other current liabilities are approximately 6.7 million. This increase is due to our prepaid expenses, and they are increases in software and subscription cost increases, as well as the workers' comp cash collateral is approximately 400,000 more than it was last year. Moving into current liabilities, they're approximately 6 million and 442,000 over prior year. Accounts payable are approximately 1.9 million, and the increase is due to timing of payments in June, so that's just kind of a timing thing. Salaries and liabilities are approximately 3.3 million, and the increase of 849,000 over prior year. And this is attributed to the timing of payroll, and then we also have higher accrued accruals for vacation and sick. So that means that this year we have fewer people taking vacation and sick time in this first 3-month period. And then estimated claims payable are at 848,000, which is a decrease from last year, and that is 100% due to the IBNR adjustment, which is incurred but not recorded for our health insurance costs. So are there any questions on the statement of net position? So moving into the statement of revenues and expenditures, after 3 months ending June 30th, we have a net gain of 837,000. Moving into the revenues, operating revenues are on budget and 8.6% over prior year, with the most notable changes in regular line passenger revenue. Those increases over prior year and budget is due to the increases of pass sales. We've seen an increase of pass sales directly on our fare boxes on our buses, which is nice to report because that's what we bought them for. Special line revenues are performing below budget but higher than prior year, and this is primarily due to the SU contract. So we budgeted that they would request more service, but they haven't requested as much as we anticipated. Advertising and others are performing in line with budget and over prior year. The favorable increase is due to the guaranteed minimum in our transit advertising contract. Moving on to expenses. So our expenses overall are 9.8% under budget and 13% over prior year. The personnel expenses, which include all the categories between salaries and wages through pension, are performing below, performing below budget and over prior year. Primarily, the reason why they're performing under budget, we budget 100% fully staffed for the full year, so we are still seeking those drivers. So this will continue to perform under budget until we see those increases. We did budget for the increases in regards to the union contract and increases to our pension plans. The non-personnel expenses, which are the categories between risk management and other employee benefits, are performing below budget but higher than prior year, with the most notable changes in risk management and service expenses. Risk management is under budget and lower than anticipated due to claims, legal fees, and prior year claims, and services are under budget because we're lower than anticipated expenses in advertising and marketing. Purchase transportation, materials and supplies and services are performing over prior year, which were anticipated in our budget. Any questions there? Non-operating revenues are performing in line with budget and over prior year, with the most notable changes in these categories are operating assistance, which is lower than budget but higher than prior year. Operating assistance is made up of our state STOA and federal assistance, and federal assistance is based on need. And then over prior year, we did see an increase in STOA. Investments are over prior year and over budget, and that's due to the favorable interest rates in our treasury bills. Any questions on the statements of revenue and expenditures? Next is mortgage recording tax. This, we continue to see a dip in this year. We are performing under budget and under prior year at this point. In the month of June, we received $512,000. Prior year was $621,000, which is approximately $108,000 less than prior year. So that's just the housing market. So I guess if those interest rates do go down, we might see an
More
increase.
movement with the mortgage,
Yeah.
the refis, yeah.
Investment income, this is our cash and restricted funds, operating cash, and, at the end of June, we had approximately $17.7 million. In investments, our, market value as of June 30 was $19 million, and the anticipated amount at maturity is $19 million, and the maturity value was 19.3.
Back to the one that's slide before.
Yeah.
Okay, I'm gonna talk to you.
Cash flow, at the end of June, we had an approximately $12 million in operating cash, and, total cash including investments and reserve funds, we had $35.3 million. So healthy cash flow. Any questions there? So with that, that concludes my report.
Questions from Melissa? That was a good report. No questions, I have a motion. Tony, second. Tina, any discussion? All in favor? Aye. Okay, moving on, I guess, Chris, you got it all today?
That I do.
Carrie, you let him go? You let him go with all the work today, you guys? Nobody else is coming up? Nobody else is coming up today?
It's on vacation.
Hey, Chris, you got it all today?
That is true. I do have 4 separate resolutions this afternoon. Good morning, or good afternoon, everyone. Yeah, I did too.
Yeah, it's hard.
Days from
We're
now.
gonna start with resolution 3A, the body shop and paint supplies.
Thank you, Mr. Chairman. This resolution is for body shop and paint supplies. The contract will be paid for using operating funds. The invitation for bid was publicly let on March 25th. 25 vendors were invited, of which 6 were sent to certified minority and women-owned business enterprises. In total, 13 bid packages were downloaded. On April 15th, 1 bid was received from Napa Auto Parts. The pricing received from them is accompanied in your your board packet in the following 3 or 4 pages there. I will tell you that there are over 200 individual line items on this contract, so there's quite a bit of information there. A full waiver for MWB participation was approved by New York State Empire Development. Therefore, it is our recommendation that the board award the contract for body shop and paint supplies to Napa Auto Parts for a full 5-year term.
Questions for Chris? Okay, pretty straightforward, we have a motion. Monty, second? Second. Joe, any discussions? All in favor? Aye. Okay, moving on to resolution, 3B, which is the Regional Transportation Center Janitorial Services.
Thank you. Moving right along, this next resolution is for the janitorial services at the RTC. This contract will be paid for using operating funds and is a 5-year contract. As a part of our procurement process, we are obligated to evaluate all the specifications of every contract before we advertise them to the public to ensure that what we are requesting of vendors does not fall under New York State preferred source offerings. In this case, janitorial services does fall under that category of preferred source offerings, so we're obligated to send these specifications to the New York State Industries for the Disabled. They have the opportunity to bid on this contract or pass it up. If they do bid on that, we are obligated to proceed with them with the contract. In this case, pricing was received from Human Technologies Corporation in the amount of $268,949 annually, and North Coast Community Options in the amount of $2,825 annually. North Coast Community Options will be performing one service on this contract, which is high dusting. They come in once a year and perform that service. HTC, Human Technologies Corporation, will be performing everything else that's under this contract.
Chris, wanna give a little background on Human Technologies, what they're kind of about a little bit?
So to be honest with you, I don't know too much of the company. They are a New York State preferred source. They do the janitorial services for all of our
I'll jump in
locations.
there a little bit. They deal with a lot of individuals with disabilities that are working, so it's nice to, they're based out of Atlantic County actually. And, a lot of individuals that are disabled, you know, and, with good support and everything. And it's just nice to see them, get some work here. They've been here, but I know it's nice to see them continue.
Absolutely.
Okay, any questions on that discussion? May I have a motion? Okay, Luella, second. Tina, any discussion? All in favor? Aye. Okay, we're gonna move on to, administrative point of sale terminal purchase, Chris.
Yes. This next resolution is for 7 administrative point of sale terminals. The purchase will be paid for with 100% state dedicated funds. The point of sale terminals are needed to print Magnetic Plus passes, encode smart cards, and print patron photo ID cards as well. GenFair, who is the provider of our electronic fare collection system, also manufactures these point of sale terminal machines, deeming this a sole source procurement. Pricing was received from GenFair in the amount of $251,687. Therefore, it is our recommendation that the board approve a purchase order to GenFair for $251,687.
Questions regarding the terminal?
This was not included in the previous Gen Fair.
It is not.
No. So this will allow us to generate media that communicates with that fare box. So what he referred to as smart cards is
Right.
essentially using your card RFID card that you can tap on the fare box. So it allows us to encode those to communicate with the fare box to provide a different type of media that customers can utilize.
Could you use those for Snap ID cards?
I don't know. It depends. We'd have to talk to GFI to see if the encoding on those cards can communicate with the fare box. We're working on something similar to that with the school district right now. So it's possible, but right now I don't know that answer. But this will allow us to get into that opportunity to be able to do something different than just cash or a magnetic strip.
Any other questions regarding that? I have a motion. Julius, can I have a second? Luella, any discussion? All in favor, aye? Okay, moving on to, resolution 3D.
Yes. Last but not least,
Executive recruitment services.
yes, we have the resolution for the executive recruitment services. This contract will be paid for using operating funds. The request for proposal was publicly let on April 4th. 52 vendors were invited, 27 of which were certified MWBEs. In total, 60 proposal packages were downloaded. On April 25th, 3 proposals were received. An evaluation committee composing of Anthony Davis, Darlene Lattimore, Jackie Musengo, Monty Flynn, and Tina Fitzgerald met and determined that TransPro Consulting offered the most advantageous proposal for the CNY RTA. A partial waiver for MWB participation has been approved by New York State Empire Development, amending the original goal of 30% down to 20% on this contract. Therefore, it is our recommendation that the board award the contract for executive recruitment services to TransPro Consulting. And I would like to say that the $40,000 reflected in here is not inclusive of all of the costs. And some of the direct expenses, such as travel for on-site interviews or placement costs of ads, are going to be incurred after the fact.
So first this was kind of, involved process here. Okay, an involved process for a volunteer board. Okay, when all these came in, then you had to, go in the system and kind of rate what you felt about all of the companies, okay? And I'm glad that I asked Anthony, Darlene, Monty, and Tina to take the lead on this project. They probably will never take the lead on another project. Okay, but it was involved. This is something, when you're evaluating firms like this just doesn't happen within minutes, okay? It's taking people's time and going through it. And Chris, thank you for your patience with everybody that I asked to help you, okay? Which
We won't
helped
mention
out.
any names.
But as you can see, on one of the low bids here, it just, and why don't you talk a little bit about, Chris, the Trans Pro, what they do, okay? Is this what they do?
Right, so Transpro Consulting is interesting because it really seems, going through their proposal, that this is essentially their bread and butter. They have hired numerous executive positions or C-suite level positions in their past. They have a large bench of executives or who have been on public, who have served as public chair members, C-level suites. Again, reading through their proposal, it seems like most of their, if not all of their services are in the public transport section. If not public transport, definitely public. It was really the focus of what they do.
And when the ratings went in on what the board members did, they didn't know what each other was doing. Everybody was doing this kind of independent, but when you looked at the end, you saw the end result. They were in consensus of this firm to present.
Correct. Yep, and it is worth noting too, staffing and recruiting, I had these backwards, actually submitted the bid for 80,000. Corporate Hiring Solutions submitted the bid for 9,800. Corporate Hiring Solutions is a certified MWBE, but I would like to also just state that pricing isn't the largest factor when it comes to this. When we normally do invitation for bids, we're obligated to go with the low
This
bid.
is professional services,
Exactly,
okay, which is different.
exactly.
And professional services could be, when we talk professional services and we don't go right to low bid, it could be accounting service, it could be engineers, could be architects, okay, it could be those are professional services. Okay. This is good work, and the start of a process that will now, start moving. Does anybody have any questions? Okay, may I have a motion? Tina, second. Tony, any discussion? All in favor? Aye. Chris, get them on the phone Monday.
Will do. Thank you very much.
Thank you. Okay, Melissa?
I just have one additional or two-ish additional items. I'm pleased to announce that in the month of June and early July, we were awarded 2 competitive grants, one for $5 million and one for $7.26 million. And those grants will help fund the introduction to hydrogen fuel cell for fleet. And so the combination of those 2 grants will help fund 4 to 5 buses, a fueling skid, the infrastructure for those fueling skids, so like a bay, electrical, and then training.
Is that 100% of what our cost might be with that money, you think?
There is a local share. So the grant for $5 million actually is $6.25 million, but that's made up of a local and state portion. So to make up that additional $1.25 million. But all in all, it should cover the cost with that to bring in those vehicles to dip our toe in the water with the hydrogen fuel cell technology and really see if it's something we can continue to pursue for our future fleet transition.
I like the aggressiveness of leveraging other funds as we look at this, because I don't think none of us are experts on this.
Yeah, there's a lot of different opinions in the technology, especially in the zero emissions market. So, you know, hydrogen, we've seen battery electric make a big push. We certainly see it doing well in the car model, but the heavy equipment model hasn't been as consistent.
My car model of a hybrid of a brand new vehicle has been 15 recalls, so I've had a hell of a
Yeah.
with that.
The hydrogen technology is fairly new, and certainly we know there's a large increase in cost from our current CNG vehicles to a hydrogen fuel cell vehicle is roughly about $1 million a vehicle increased cost that occur. So
I think
before we invest heavily, we want to make sure
I
we
agree.
dip our toe in first.
No, and I knew you guys were working on that, and I think that's good because it's a big change.
Yeah.
Big change in the bankers.
Yeah.
For the, personnel that's gotta work on this stuff, you know.
Mr. Chairman, the grant for 7.26, that is only the federal portion. There is a 20% local state share.
Sorry.
I knew you would get involved somehow, man.
I haven't talked to you in a while.
All right, good, okay, good stuff. Melissa, anything else?
That's it.
Okay, we're gonna go, direct, unless anybody wants to take a few minutes, or you wanna go directly in? It's a pleasure of the board. Go directly in, or you wanna take 5? We want to go directly in? Okay, we're gonna go directly into our meeting, and I know this is long today, but like I said, we spent a lot of time, but there's a lot of, responsibility we have with those pensions. That's why I thought we needed to go slow. Okay, folks, we're gonna go, we all set over here, we'll go right into it. Let's stand for the Pledge of Allegiance. John Mela, why don't you lead us in the pledge today?
Thanks. With allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, we're gonna note that quorum is present. We had a rough time here in the last month or so, where, I'm gonna ask for a moment of silence on 3 great employees that we have, lost. And I think it's appropriate, I want to thank, Chris and the team to keeping the board aware of this. I think this is appropriate. So the first person is Warren Woodruff. Woody was the general manager at Central from 5/22/72 through 9/1/94, where he worked closely with Warren Frank, the executive director. Not too many of us around the table met Warren. I had met Warren. He was quite an interesting person. So we're going back here with some of these folks here that have really been the foundation.
I will agree with you on interesting.
Yeah, been the foundation though. These people have been the foundation of kind of where we are today. He returned to Central on a part-time basis as a project coordinator from 2000 to 2008. Also, Joyce Labisco worked at Central from 1978 through 12/1/02 and ended her career as the first woman operations manager of Cayuga Trailblazer from 1990 to 2002. Dana McMahon worked at Central for 35 years as an operator. He started at Central in 7/25/83 as a part-time operator, was promoted to full-time operator in 3/29/84. He retired on 12/1/10 and then returned as a part-time operator until he retired in 18. So I'd just like to take a moment of silence to these people that really have helped out to create an authority, kind of bring us to where we are today. Thank you. Okay, also, today, Ed was not able to make it with us today, but he said, go forward, okay, on a retirement. So at this point, Ed Muller, we'd like to recognize Ed for his 32 years of service with Central, and started here in 92 as a bus operator and was promoted to management in 03 as the manager of schedule development. He ended his career as a director of service planning. We'd like to thank Ed for all his years of service at Central and wish him well in his retirement, and the appropriate acknowledgement will be given to him.
Yes.
Okay, so congratulations to Ed. A round of applause. Okay. Next meeting date will be August 23rd. Governance, audit and finance board, and then the board meeting will be around 10. I have a motion to approve the regular minutes of June 21st over 24. I got Tina, I got a second with Julius. Any discussion? All in favor? Aye. I'd like Deputy Chief Executive Officer report, Chris.
All right. Thank you, Mr. Chairman. Good afternoon, members of the board. I'll keep my report brief to in respect of time. But as you see in the report, we did do a drawdown in June of COVID funds, so we continue to draw on those funds. We just shy of $11 million remaining, that will continue to draw down in the remainder of this fiscal year, which we think will probably conclude those funds. As we continued in previous conversations, we've met and invited numerous of our local legislators to come down to the central office and see what we do behind the scenes. It's easy to have a conversation in their office and talk about funds, but to let them see where we're putting those funds to use and what the building and the facility looks like as we continue to operate helps add some context to the conversation that they now have a reference point to look at. So we hosted Senator May and Assemblyman Sturpey for those tours. They continue to be great conversational tours and really eye-opening to them to see how the facility is run, that we're larger than just the hub. We joke around that a lot of people say, you work at Centro, the first thing they ask is, are you a driver? And then, or they reference and say, I drove by your office the other day, and they're referring to the hub, which clearly we wouldn't all fit it. So to show that and kind of show them more behind the scenes that there is a whole maintenance department, there is a larger admin staff in the 4 counties. So it's great conversations, and we continue to do that. We do have Senator Mannion and Assemblywoman Hunter coming in the next 2 weeks. So we will continue that roadshow and certainly extend it along to our congressional on our federal level as well. Quick update, mission, vision, values. So the staff has been evaluating our mission, vision, values for a number of months. The last couple of weeks, we did a little bit of a roadshow and updated the staff on that to get some feedback on what their perspective was and where we were. Ultimately, the meetings went very well, and we look to bring this proposal to the board and governance next month. So just giving you an information piece and keep you on the lookout for that. We've continued our various meetings, our RPM program, capital planning. Flowing into the RPM program, we what we call is our RPM Roadshow certainly commenced this week in representing and identifying our employees and their incentive program. So we traveled to Oswego and Auburn, Utica, Oneida Properties, and Syracuse. And during that, we recognized years of service for individuals. So we've had a couple of people up with 30 years of service in the last quarter for their anniversary to individuals that have been here as early as a year. So it was a great opportunity to represent them and thank them for their service. And we also recognized 2 employees for the operator of the quarter, which was an individual here in Syracuse, 22 years, Bill Kirschbaum, and our maintenance employee of the quarter, which was an individual out of Utica, Vitaly Viktorovich, who's a 9-year employee that do exceptional work, highly respected by their employees. They come to work, very dependable, and do great work where they're here. And the program continues to do well, and we continue to make improvements on that and the feedback with that. 2 other things quick. On July 18th, we hosted the New York Public Transportation Association, so NIPTA, their Public Transit Leadership Institute, or what we call PTLI, which there's many of us here now in the management level that are alumni and current individuals. We have 7 that are in this program. So we hosted that 6-part program here in Syracuse. So they traveled to all of the authorities across the state, including New York City, to learn and really grow into mid and senior level managers that want to advance their career to the executive level. So we hosted them in Syracuse. We did a tour. We did an overview of future projects and things that we're working on here at Centro, and showed them some of the new technology that we're implementing that other agencies are not. And it was a great program, very well received. Our team certainly enjoys it, and we look forward to continue to build on that. One last piece I wanted to inform the board on that we are happy to announce. We've had several conversations about Oneida County Rural Transit, which was previously run by Bernie Bus and was suspended back during COVID. And we were asked to take over that service, and working through the process with Oneida County Rural Transit, New York State DOT. The Oneida County Legislature did pass a resolution earlier this month to implement that service, with us taking it over and transfer funds that they currently have to operate that service. That service will start in the city of Utica, travel to the city of Rome, and then continue on to Turning Stone Casino to try to connect some larger employment centers, Mohawk Valley Community College in both Utica and Rome, in Oneida County. We look to launch that service in the fall of 2024. Any questions on my report? I know it was quick.
Well, Chris, you indicated on your email that this is about the storm that came through.
Yes. So we did have the storm that came through the city of Rome. I'm sure a lot of us were part of that. I'm happy to say in the update I gave to the board earlier this week, we didn't suffer any major damages to our facilities, our equipment, or to our employees or their families. I was out there on Wednesday last week to do an inspection and meet with the team. We got the service back up and running. Late Wednesday, Thursday, we got most of it back up. Friday morning, we were full running, regular schedule. And this past week, we did do a couple shuttles for the emergency management department in Oneida County to connect some individuals to some resource centers in the city of Rome to get supplies and help support them during those
I
efforts.
stayed in contact with myself. It was a mess. I don't know if you guys saw this, but
friends in
buildings
Rome.
collapsed. It was just, I've never seen, like, we hear these things, but way over there, like not around here. But what happened in Rome, I just could not believe the destruction that occurred, and very proud for Central on how we got back online so quick, because boy, was that, I was talking to a public adjuster that was out there that day, and I met him that night or something, and he told me you couldn't even drive around streets out there. That's how bad this was. And if anybody's familiar with Griffiths, well, now it's a business park, but it used to be the air base. There's an old bomber that's kind of set up there. That even went over.
Yeah, it picked it up and moved about 20-25 feet off
Oh
the
my
pad.
goodness.
Yeah, so it was a lot of destruction. People's lives have been turned upside down, and hopefully, let's pray for them that they get back together. But Central once again did what they needed to do.
Yeah, no, very proud of the folks out there to step up. We had some folks stay late after on Wednesday night to help assist with some of the service, or Tuesday night, sorry. And then, we've been running that free shuttle to help the residents get to the resources. So they came together, and we're proud of that. Any other questions on my report?
For the service in Utica, are we picking up?
Yep.
Are we getting any, I'm thinking we're using drivers that they were using. Are we getting any additional? I mean, do they have?
No, so we have, the Utica team has assessed their driver pool that they can be able to do this with our existing pool. So Bernie Bus was contracted to do this service. Certainly with the sale of Bernie and things changing, they've gone elsewhere. And then through this process, this service was suspended for a couple of years now. So we're proud to bring it back online to help out Oneida County. So our drivers will run the service. We already have vehicles that we've purchased a couple of years ago that will help support this. And then we will receive some additional funding that the county is currently receiving for rural transit operating assistance. So that'll help fund this service. And then as we see it pick up, we'll continue to evaluate it from there.
Is that Oneida County or Mohawk Valley? Or?
Just Oneida County right now.
Anything else?
No, nothing on my report.
Questions for any other?
We do have 2 items we have to present from the senior staff. So I'll call up Josh to give a call to us quarterly quick.
Good afternoon, everybody. I'm glad that Chris called me first because I think Paula's next and you do not need her excitement. It's not today? Okay, good. All right, so call us report for the first quarter. It's been staying consistent. The consistent thing is ridership is up. Paratransit rides are up about 12% over previous year. We continue to see anywhere from about 11 to 14% year over year. We have far exceeded pre-COVID numbers. We exceeded that last year, and we just continue to rise. Other than that, there's nothing really remarkable in the stats. They remain consistent. One thing I did want to mention, we were a part of the ADA parade today. Today was
And we're wonderful. And we're wonderful, wonderful,
Thank
wonderful.
you so much. It was the 34th anniversary of the signing of the ADA, so we participated in that today. And that's really all I have. Does anybody have any questions on the?
Oh, you should talk about what I did the last 2 weekends, because that was pretty.
So I was going to try to keep it short.
Enlightening. I did something that was very enlightening.
You got the floor, kiddo.
And Tina, we were gonna address it with the next one too, so that way we could talk about how we finish it out. But we have been doing our vendor training, and and Tina's been a great part of that. So the last 2 Sundays, we had Tina with us, doing the vendor training. It's about 3 hours on a Sunday. And we'll do the final one this Sunday with the vendors, and we'll cycle through the last few that we have. But all those drivers come through every year for refresher training.
And I was able to help Josh pointing out, this is not anxiety because they're doing it in front of you. They do it this poorly all the time.
Yeah.
So I got my moment to say, see, these drivers don't do their job right.
And what we do is we bring them all outside, and we actually had Tina on the bus, and they had to secure Tina's mobility device as part of the security.
Good job, Tina.
Well, I told them, I said, it would be in very poor taste if a board member went through the windshield of a call bus, because I would have to sue everybody. Very poor taste, so secure me appropriately, please.
I don't think I would even, I don't know, I think I would have been scared.
Adds a level of intimidation, for sure.
Well, no. A lot of the drivers do know me and approach me,
Good.
and you know, by name, they knew who I was. So
I think it's good because, you know, you're there, you're receiving that service. No one knows it better than you, Tina, I know that.
And
That's great,
having
thank
Tina,
you.
and having Tina there brings the customer perspective as well.
Yeah.
All right, rather than just the authority's perspective, the customer's perspective too makes a big difference to the vendors and the drivers.
and I think my presence, because I ride almost every day. Josh will tell you I ride almost every day. I think I've been able to build a rapport with the drivers that I see on a super regular basis. And I've been able to answer questions because some of the drivers were confused because there's a checkbox on the manifest that says accepted seatbelt or MA, which is medically excused. And they thought that that meant that people did not have to wear their seatbelts. No, everyone must wear their seatbelt. If you're in a seat, if you're in a wheelchair, you must wear your seatbelt. And they're like, no, that's not what the man, yes it is.
Yeah. So we're able to explain to them it's a medical exemption that only DMV can provide. So if they get the medical exemption, that's the only time they don't have to wear the seatbelt on the vehicle, but it has to be from DMV, and we get a copy of it, and we don't currently have anybody. So we explain that all to them, what that meant.
Good, no, I think Tina, thanks for your help. We really
I
appreciate
told Josh wherever he needs me to work it in.
Good.
You know, I am willing to go talk to people, I'm willing to be the demonstration dummy, whatever you need. Though next time I think I might bring my scooter. Really mess them up.
No, and it's good. So when we do the training in-house too, and when it's their first time, we bring manual wheelchairs. In-house, we have a manual wheelchair, we have a power wheelchair, and we have a scooter, so they can get used to tying down different mobility devices. And I think last year, bought a transfer chair, which is like a manual wheelchair, just a little bit different. And we have that on.
And what I learned the other day about that is you can't take it on medical transport. You cannot take a transfer chair. It's not considered a safe mode of transport.
Correct.
But I'm like, how can two federal? Nothing makes sense.
Yeah, the FTA has made it clear to us that it meets the requirement of a wheelchair, so we have to transport somebody in a transfer chair.
And that's that chair with those little tiny wheels that you can't wheel yourself.
Wow.
And they're very scary. I sat in one once and said, no thank you.
They don't feel as scared.
Yeah,
No.
that's good resource, way to get a good resource there.
Thanks, Josh. And then we have one more piece to call Brent up to talk about some service changes.
Good afternoon.
I know it's the one here.
Just plug in my computer so now you can see what I'm talking about. That's why I need to pull up. Okay, So I wanted to talk to you about the SY 84, which is the Maddie Airport service. And you know that last year we changed the service and we took out some of the neighborhood deviations on this route and we added in the airport. And really the reason we did that was because we've had so many comments over the years about airport service. So we operate on Route 11 between North Salina Street and Lawrence Road in North Syracuse. Again, we added that service, that green loop into the Hancock International Airport. And we also established an airport fare-free zone between the parking lot on Air Cargo Road and Terminal A. That's for employees, airport employees, to be able to park and then get to the airport quickly in inclement weather. So we continue to operate 26 trips daily. It's the same amount of revenue hours with an increase in revenue miles because of the location of the airport. And now we make no deviations to the service. It makes it easier to understand, easier to navigate. And so I wanted to talk to you about the Title VI requirements. As you know, we have requirements out of the Civil Rights Act that tells us that we need to consider disparate and discrimination impacts when we make any changes. Basically, if we make a change that is more than 25% of the route, then we have to look at it and make sure that we're not keeping anybody out or impacting them in a negative way. Our policy reflects what the FTA tells us to do, which is that any change in route, specialized service or experimental route, again, that changes by more than 25%, excuse me, or the length that changes by more than 25%, then becomes a major service change, which is subject to an equity analysis. So we've been working on that.
And then is it, you to go with a public hearing?
We do, yes.
Yeah.
So the next step will be a public hearing.
Yeah.
And that's part of this process as well. So the last time we did an equity analysis, we brought you a similar presentation and we're kind of prepping you to say, hey, the equity analysis is coming. It's in the middle of the process, but because we haven't finished the community outreach yet, we wanted to give you an update as to where we are and then where we're headed. So again, Paula is doing all this backdoor analysis and did a great job with these maps as well. She looked at the identified locations of discontinued stops. So you can see those blue dots are the discontinued stops that we have taken out. And the yellow dots are the active stops that we put in.
And I can say those inactive spots, because I live on Roxborough Road, so you're actually showing my road on this one. Nobody was ever at any of those bus stops, ever. In the 17 years I've lived in my house, nobody did I ever see on those stops.
Good feedback. Good feedback. So we did a little bit different analysis this time. We looked at walk sheds. So sometimes we look at the whole route and say, is it impacted more than 25%? But in this area, in this instance, we wanted to look at the neighborhoods and say, the folks who are on this route, are they impacted, right? So Paula did this walk shed analysis. She looked at 1/4 mile and 1/2 mile walk sheds. The blue is what used to be, the orange is what is now. And then she overlaid the two walking areas to determine which discontinued stops fall within the active stop walk area. So we assume that people can walk between a 1/2 mile and a 1/4 mile, or 1/4 mile and a 1/2 mile, with no issues to get to a bus stop. So then once we took out the areas that they can walk to on the new route, you can see the blue bubble around those discontinued areas are the walk shed that is not within the active stop walking area in the area. We analyzed the impact then on minority and low income residents of the impacted area. And we found that they are less than 20% of an impact, which means they're not a disparate impact to minority persons. They're not a disproportionate burden to low income households, and that's our goal. However, we thought, okay, so we know that federally we're covered, but how do we really impact the folks in this neighborhood? So, we put in we considered mitigating service, which is this alternate service, actually SY80E, which hits North Syracuse and goes up to Central Square, continues to serve Burgeon Road between West Taft and Chestnut Street. So a good portion of those dots that were in that blue area on the last slide are now in a purple area, are still in a purple area that says, yep, they're covered by this other route. This reduces the affected population, obviously, and this analysis was really cool because it's different than we've ever done an analysis before, and we got to dive a little bit deeper into the actual neighborhood. So in conclusion, the modified routing provides consistent and reliable service. It provides the opportunities for transit-dependent residents to safely and affordably get to the airport, which we've been asked for years about, so it was nice to give that service, and expands the opportunities for minority and low-income persons from other areas of the city to get to the airport for employment.
How big is the impact on Allen Road and Chestnut Street?
Well, the impact is, let me get to it. It does impact some, but it is less than 20%. So it is not causing a major impact on those neighborhoods.
I guess the real question is, how many people get on and off the bus in that area?
I don't have that answer off the top of my head, but I do believe that there are more folks getting on at the airport. Obviously, we didn't have airport service, so we've seen an increase in that service. I don't think our ridership has gone down on that line. So our next steps, we are continuing public engagement. So right now we have some information up on our website. We've put a press release out, and we are holding a public hearing on August 13th at the, I wish I remembered the name of the park, Burnham Park, up there in that neighborhood. This is super exciting because, hey, you see this community bus on the street? We are holding our first public hearing inside a bus. So we really wanted to be right there in the neighborhood that is being impacted so that we could get their feedback. We haven't gotten a lot of negative feedback. We've gotten just a handful of negative feedback, and I think just as much positive feedback about the airport service. But again, we wanted to be out there in that neighborhood. So we're taking the bus out to the park, and we're gonna have a public hearing on August 13th at 5 p.m. Y'all are welcome to join us. It's gonna be great. We're super excited about this community bus. And then we'll continue the public comment period will be open for a little bit longer. We'll continue to evaluate the public hearing feedback, and then we'll complete our service equity analysis, which will come to the board, I think, in September for your full approval. But again, because we're not done with the public input, we're just giving you this heads up.
Thanks for the update.
Thank you.
Any other questions for Brent?
Is there any way to keep the Allen Road and Chestnut Street service and the airport?
No, because of the offset in hours and miles, we're not adding service right now until we get more drivers. So we weren't able to keep both services. But we were able to minimize the impact.
I don't have the exact numbers, I'm sorry if I can just.
Please.
I don't have the exact numbers on me for that area, but the ridership was very, very small for that area.
So I do need a motion to approve this draft equity analysis and to continue the process as
I have a
outlined.
motion. Tina, second. Julius, any discussion? All in favor? Aye. Thanks, Brent.
Thank you.
Well done.
Mr. Chairman, that concludes my report and the VP reports.
Very good. We're gonna go right to audit and finance. Everything was discussed on committee. We're gonna first start out with, may I have a motion for our first quarter financial statements that Melissa gave us, strong fiscal report. I have a motion. Monty, second. Tony, any discussion? All in favor? Aye. We also then, had a, John came in, our general liability question has gone up a little bit. And, what we need is a motion to approve this and move this forward. Julia, second. Luella, any discussion? All in favor? Aye. Workers' compensation renewal, Doug came in, we saw some great numbers here, boy, I hope they stay, but, they look really well. And so we want a renewal with Travelers, may I have a motion? Tony, second. Tina, any discussion? All in favor? Aye. Chris brought, forward, 4 resolutions. First one was Body Shop and, paint supplies to award contract to, Napa Auto Parts. May I have a motion to approve Napa? Tina, second. Tony, any discussion? All in favor? Aye. Then we had resolution 3B, janitorial services to, award contract. The bulk of this is going to Human Technologies, for $268,949, and also a small, amount, $2,825 to North Coast Community Options for some high dusting. I might need them for my house. Okay, my wife would love me. I have a motion for that. Luella definitely on the dusting. Second, Julius. Any discussion? All in favor? Aye. Contract award for administrative point of sale terminal purchase. There was some nice discussion. I think Monty brought up something good that I got educated on. So, made to Gen Fair an amount of $251,687 to furnish and install the administrative point of sale terminals. May I have a motion? Monty, second. Tina, any discussion? All in favor? Aye. Once again, I'd like to thank the group of board members that put the time in to dissect these contracts for the executive recruitment services. A decision was made to award contract to TransPro. Chris did a great job. TransPro is what they do. This is the work they do. Okay, so I'm happy to bring this forward to award contract to TransPro Consulting for a cost of $40,000, but there could be some indirect costs.
Correct.
That could come with this. Okay, just want to make sure everybody's aware, make sure the minutes reflect that. We have a motion. Tony, second. Tina, any discussion? All in favor? Aye. Okay. Now, Joe, pension committee report. We don't need a motion, but you want to say a couple words?
Sure. Pension committee met earlier this afternoon. We had 2 presentations. The Lesko advisors came in and gave us a detailed overview of the results of the second quarter authority's pension investments, as well as an in-depth overall market discussion. We also heard from Greg Stump, who was from Boomershine Consulting Services and Actuary. He detailed our projections for our pension liabilities for the next 5 years as to whether it's sufficient or insufficient. There were no actions taken, and that's the result of the pension.
Very good. Thanks, Joe. Appreciate that report. Old business? Julius?
Well, this is not it's kind of like a new business.
Is it new business?
Yeah.
Okay, how about this? Future business?
On the 300 block of West Kennedy Street, there's some major changes going on in there. We got new houses, and we're gonna have new sidewalks and stuff like that. And also the streets improvements, gonna be doing some streets improvement. And a lot of people are asking the question why they reroute Central from the major Midland John Upgrade. One of the things that I feel is that because a lot of the people who were going through Price Right need to ride, so that's it. So I want to make sure.
Yeah, we wanted to make sure we get Price Right coming down that corridor. That was something we did a couple of years back.
And right now, I'm hoping we get the city to do a kind of like what you call a script across the road. Yeah, because the traffic is pretty heavy in the area right now.
I wish Neil was here, actually, that'd be perfect. Yeah. You can follow up on that, Chris, or, okay, anybody got anything for order? Okay, Need a motion to go into executive session to discuss the contract. Motion, Robert, second. Julius, any discussion? All in favor? Aye. Thank you. We just need Chris, Aaron. I need Chris. Chris,
Yeah, I got you, Joe.
the vice president is saying, one of the vice presidents.
Yeah, I asked that.
Yeah, Jackie, you can stay.
Jackie, yeah.
So these are not, my goodness,
You guys
these
can
are
hang out right outside there. Yeah, it shouldn't be.
So these are just so they don't really adjust.
Did you get who seconded the executive session?
got it.
I didn't, so that's the what I did.
A higher bill, so. They financial disclosure statement. They don't, you know, that they put in everything.
Yeah, Frank, I'll be down for
Oh, you do that? You gotta do that. Cause it's just, like money.
Okay. Thank you.
Am I supposed to go to
I wanna-
state?
I'm gonna make this, Okay, folks, we just came out of executive session, no action was taken. Everybody have a great weekend. Thank you.
Thank you.
Okay, folks, we just came out of executive session, no.
Hey. Incredible. I didn't think she was faking it, you know, when I was talking to her.
Yeah, her son was.